Many investors that have been extremely successful in the traditional markets, let's say with property or with stocks, they tend to not be as successful in crypto. Because with traditional markets, things work very differently. In traditional markets, we can value the asset based on its future cash flows. We can try to figure out what will be the future dividend payments of this particular stock. Or we can try to estimate what will be the future rental income streams coming from that property. And based on that, if we just project it out in the future, put this to the present value, we can then figure out what's the fair value of an asset. This does not necessarily work with crypto. Crypto is much more intangible. Crypto prices are much more directly determined by demand and supply. They're much more determined by what's currently trending, where's currently the attention, what's currently the reference price of the average investor. Because the question whether or not you're currently in profit or in loss does have an impact where the Bitcoin price will go from here. This is a chart I like to show on this channel regularly. It's the realized price. So we've got the long-term Bitcoin price here. That's the line in black. It's a very long-term chart that starts in 2010 and it's on a logarithmic scale. So you can see how in the early days the price tended to rise faster in percent than it does today. But of course in US dollars it now goes up more. Now the realized price is a special form of moving average. It shows the average cost basis of the typical investor in Bitcoin. The current price today is simply what Bitcoin was traded for just recently, who bought and who sold. But the realized price looks at all of the Bitcoin that have ever moved and it checks at what particular price did that Bitcoin move. Thus, we can see what's the reference price of the average market participant. If the current price is above, then people are in unrealized profit. So that's then when the number in the brokerage account is green and when the current price is below the realized price, below that orange line, that means the average investor is in the red. Now, why does that matter? It matters because the individual purchase price is always what we have as an anchor point. Psychologically, this effect is extremely strong. Let's say you are currently at losses with your crypto position, let's say with Bitcoin, but you do believe in Bitcoin over the long term. You do believe that it's the hardest of the monies, it's got a shrinking circulating supply. It tends to outperform just buying and holding US dollars because US dollars tend to expand in supply. So long term, you believe in the Bitcoin story. If still you're down on your Bitcoin position, you're probably very unlikely going to sell that position. You're simply just waiting it out until things recover. There are similar psychological effects for the property market as well, but again, for the property market, we can figure out if currently something's rather expensive or rather cheap. With the Bitcoin market, we purely just have that anchor point. The same also works the other way around, right? Let's say you start off with a Bitcoin allocation of your entire net worth of say 10%. And you do this at a pretty good timing. Bitcoin now goes up by multiple X. Let's say you buy for 20K after a crash and then it recovers to 100K, 120K. You made a 5 or 6X return. So you start off with 10% allocation. Suddenly you're at 40, 50, 60% of your net worth being in Bitcoin. What are you going to do at that point in time? Of course, you're going to reallocate, right? You're going to take some profit, you're going to take some chips off the table and potentially allocate this toward other asset classes or maybe just consume that. So looking at how much people are currently in losses or in profit is a very useful tool. It does not necessarily tell us the fair price of Bitcoin, but it does tell us when the market is extremely depressed and when selling pressure is likely going to dramatically go down. And we then see a reversal after a bear market. Now, unfortunately, that realized price is currently very far away from the current price. Whenever we are below that realized price, it's a phenomenal time to buy. But the problem is we cannot wait until we are back below the realized price. Because have a look at this. Let's say you were in 2016 and you were above the realized price by roughly 2x. A similar situation to today. and you wanted to wait until the current price falls again below those $300 or $400. Had you done that, you would have missed out on a rally all the way up to $20,000. From $600 to $20,000. That's more than a 30x return. Now, I'm not saying that we're going to see another 30x return from here, but what I am saying is that waiting for a drop below the realized price is a very, very dangerous strategy. It's a good sign in general to buy much more when we are below, when most people have given up on Bitcoin, when we are just at the end of a bear market, but it's not necessarily always that smart to wait for that next bear market. There's another argument that we might have to wait quite a long time until we fall below that average cost basis again. And that's the current investors that buy into crypto, especially into Bitcoin and into Ethereum. And that's the institutional investors, and it's the ETFs. And those entities over time tend to just accumulate. They rarely sell. And because of that, because the buyers keep buying and they tend to not sell, of course the liquid supply shrinks even further, and of course the price has to rather rally. At least that's more likely. This here is the number of Bitcoin that's held by the ETFs. This chart starts at the beginning of 2024, so there's almost 2 years of data now. And there are times when the accumulation slows down, but very rarely do we actually see the balance itself coming down. And if it does, it's just a temporary setback. Overall, over the very long term, the Bitcoin ETFs buy more and more of the Bitcoin. And with Ethereum, we see now a similar development. Here, the acquisition is a bit more volatile though. This chart starts half a year later, so in the middle of 2024. And here the accumulation recently is quicker. But again, it's more volatile than Bitcoins, so we don't really know how the relative performance will be anytime soon. Especially for the treasury companies, the track record is very, very short. Tom Lee's Bitmine is currently buying very, very quickly, but the problem is always that those treasury companies tend to only be able to buy when the price is already high. This is now the purchases by MicroStrategy. MicroStrategy just bought Bitcoin regularly, but in a bear market, when the price is depressed, then the collateral that those treasury companies have on their balance sheet is also worth less. So they can borrow less against it, so they can lever up less. Thus, the treasury companies are forced to buy high. They are not selling low, but they're definitely also not buying low. They're simply just buying high and keep accumulating. And so because of that, it's a bit hard to argue that this time is different, because we've already lived through a bear market while the treasury company did exist, right? We did have Michael Saylor with MicroStrategy. Still, even though Michael Saylor was around, we saw the dip from 69K all the way to 16K. So just because there is an ETF and just because there are institutional treasury companies doesn't mean that bear markets are a thing of the past. We have seen something of exactly that nature already during the big correction of 2022. And so we are a bit in a dilemma. We cannot wait until the next bear market comes, until we go below the realized price, because there is a good chance we just continue rising for a while and we just miss out on the next bull market. But the problem still is that the bear market is definitely possible, because even though there are regular purchases by those institutional investors, bear markets can happen. They have happened in the past. So what can we really do if we cannot really be certain that things are going up, if there's still the danger of a potential bear market looming for whatever kind of black swan event? Who knows what's going to happen? What can we actually do to manage our risk, to still ride the positive momentum, but to exit the market quickly enough once things turn around? My favorite approach is to bet on the current trend, using moving averages and using a systematic approach, a back-tested approach with moving averages. What we see over here is Bitcoin with its best moving average, the 120-day SMA. And the idea is that we go long, or we buying Bitcoin whenever the current price is above that line in turquoise. And we go short, or at least we sell our Bitcoin, we are in cash, whenever the price is below. In other words, we avoid a crash like this, right, a 65% crash, but we are in the market, at least most of the time, while we are going up. Yes, we do have our failed signals where every now and then we get in and out and nothing is really happening. But overall, this is an approach that worked pretty well. How well? More on that in a second. But first I want to talk about this moving average duration. Why did I pick 120 days? Why not 100 days or 200 days or 20 days? 120 days sounds a bit arbitrary, right? It sounds like I just picked this randomly, but actually it's not random at all. There's quite a bit of reason behind this. Have a look at Bitcoin with the 200-day simple moving average. This looks pretty reasonable, right? We are still not in the market during a crash. We are in the market when things are going up. But there's also a disadvantage to a long duration like this. For example, here, this was the COVID crash. The price went down by close to 50% to then recover again. And we didn't really take advantage of this move. If we now take a shorter duration in the moving average, so we reduce the length, what we're seeing is that over time, this moving average gets closer and closer to the price action. So now we are at roughly 100. We're getting closer and closer. I'm reducing the duration further and further. And again, the moving average gets more and more reactive to the current price action. So why don't we take, for example, the 30-day moving average? This way, we would have exited already over here. We would have then not been in the market, at least for this 30% crash, and we would have bought in much earlier. When we zoom out a little bit, we can see how we're getting more signals this way. We have to get in and out more frequently, but in general, we tend to react faster. But here's the problem with that approach. If we go too close, let's zoom into a sideways trading range. So for example, this here. What ends up happening with a short duration like this? We end up buying high and selling low and buying high again and selling low again. And we do this repeatedly, not with very large percentage changes, but very, very often. So have a look at this. This is a buy signal, it's high. This is a sell signal, it's low. This is another buy signal, it's high. This is a sell signal, it's low. So we're buying high and selling low to then buy high again, to sell low again. It's extremely annoying. It's extremely expensive because of trading fees, but also simply because with every single trade we are losing a few percent. And the shorter the duration is, the more often this tends to happen. So let's say we go to a 14-day simple moving average or a 10-day moving average. Now we've got this buying and selling happening all the time. So this is not useful. It's not good to do this with too short of a duration. But as you have already seen, if the duration is too long, we tend to not be reactive enough. We tend to sell very, very late after we've already crashed by more than 50%. And we tend to buy comparatively late after we've already rallied by 45%. So this is the fundamental problem with a trend following strategy like this. If we follow the trend based on moving averages, we are not going to sell the exact top. We are not going to buy the exact bottom. And the question is just how close can we go with the duration that we have the right balance, that we don't get too many bad signals, but at the same time that we also don't miss the rallies and the crashes too much. And when we run the numbers, the 120-day simple moving average is historically the best. Let me show you what I've done. This is my data set. It starts in 2017. Here's the moving average durations that I've backtested. I'm buying and selling only at the end of the day, so that's UTC time zone. I backtested the simple moving average and also the exponential moving average, and I did this for all moving averages from the 2-day all the way to the 200-day moving average. We can also plot this on a chart, and then we get this over here. So on the x-axis is the duration of the moving average. Each data point here is a backtest. On the y-axis we've got the annualized return. Buying and holding during that time period would have given us 28%, so that's the line in black. If we have a moving average that's above the length of 30 days, we tend to outperform buying and holding. If our moving average duration is too long, we tend to get very close to just buying and holding. We don't really gain anything from riding the current momentum. The ideal moving average is the simple moving average that's 120 days in length. The SMA tends to do better than the EMA, and around 120, it can be 110, it can be 130, we tend to get the best performance. Now, why is this so useful? This is a great result because it shows us that in general the strategy tends to work. So we don't necessarily have to take the 120-day SMA, and if we take something slightly off, then we're going to lose our shirt. No, in general, following the trend in Bitcoin tends to work. We can't be too short in the time frame because, again, there's trading fees, there's all of those bad signals. We can't be too long because then we don't really ride the waves. But if we are in the right spot, then it doesn't really matter. Do we take the 100-day? Do we take the 140-day? In general, around this area tends to work pretty well. And it's not just that the duration itself isn't that important, it's also that the performance over time is very, very consistent. So what does this mean? 127.5% every year compounded. It means this over here. Buying and holding Bitcoin would have given us this white line over here, and trading according to the backtest, going long and short, both directions, is this line in turquoise. This is a linear scale, so we can't really see what's going on in the early days. Let's have a look at the same thing on a logarithmic scale. This is how constantly this is outperforming. Isn't this impressive? The moving average duration isn't too sensitive to changes, but also the time frame, the market conditions that we use this strategy in doesn't matter too much. We've got very constant outperformance. I like this strategy a lot. It is my favorite indicator. It is where I bet most money on. And it resolves the problem how to act with Bitcoin in the medium term. If we are not below the realized price, if we are not at extremely depressed levels, and we cannot wait until we are back at that realized price, while at the same time there's always the looming risk of a potential bear market due to whatever unforeseen black swan event. The treasury companies and the ETFs are not going to bail us out. They are buying high, they are not buying low, because they can't lever up when their collateral isn't worth much. We still have to work with momentum, but luckily enough momentum trading does work extremely well for crypto. We simply just have to use a systematic approach. And the 120-day SMA, in my opinion, is by far the best approach. It's currently at 108,000. And there's actually a chance that we see, at least medium term, a turnaround. If we suddenly close a day below that moving average, I'm going to sell a lot of my Bitcoin. I have ridden this wave quite nicely. I have entered over here with leverage, and I'm going to exit a lot of that position once we fall below. But then I will enter again once we go above. I'm okay. I'm completely agnostic and without emotions when it comes to changing my mind. It's not really changing my mind. It's simply just following a strategy that historically worked incredibly well. Will it work as well in the future? I don't know. But I think it's better than just random guessing. It's better than using the 100-day or the 200-day moving average. Using what worked best in the past is probably a good approach, especially if the market is not in extreme territory, when it's not extremely depressed or extremely heated. Now, some people call crypto just gambling, especially for the smaller meme coins, especially for altcoins. People say we're just throwing money at something, hope that it sticks, hope that it makes 100x returns. And while I do not believe that those massive returns are very realistic, I do think that crypto is not just a game of luck, but also of skill. It's a combination of both. And so the longer the game is played, the less important the luck component becomes and the more important the skill component becomes. It's a bit like with the edge in a casino, right? If you play roulette for long enough, then over time the casino will win because of that small edge, despite the luck component. And so I think it's very important to follow the right people in crypto. Follow the people that actually focus on the skill component. For example, I very much like Invest Answers. He does a lot of fundamental research. He's not always right, but he's trying his best. Or here, Benjamin Cohen. He also has some very interesting takes, especially on relative valuations. Ethereum relative to Bitcoin, altcoins relative to Ethereum, etc. It's very useful as well. Here, one of the OG Bitcoin investors, Anthony Pompliano. If you're not that much into active trading, but more into asset allocation, this is definitely a good channel to learn about the fundamentals and to learn about what's going on with the institutional investor side. It really doesn't take too much to figure out who's actually serious about the space and who's just trying to sell greed. The people that promise 10, 100, 1000x returns that always talk about those micro caps. They tend to just buy those small assets beforehand, then promote them on the channel, potentially even getting paid by those different projects, and then of course pump and dump on the audience, basically make money from the audience. I've never taken any money from any crypto project ever, and I will never do so. I get the offers all the time, but I always reject them. I just don't like the conflict of interest. I play the long game. I think when the community grows, even if it's a bit slower, but it grows steadily, then that's much better than promising to become filthy rich and getting 10x and turning $500 into $13,000. It's really not that complicated. If you find things like this, alts will make millions. This is your last warning to buy the effing alts. Or here, two 100x AI altcoins with a Lambo in the background. Then it probably makes sense to be rather skeptical, right? Those people just want to make money off of greed. Okay, so let's say those 1000x returns are very unlikely going to happen. Let's say this happens only to a small minority, potentially to the insiders, not just to people that watch YouTube videos. What is actually then a realistic long-term return in a space like crypto? Because obviously we take on more risk by buying Bitcoin, by buying Ethereum, by buying the altcoins. We're taking on more risk. We should also expect more returns. But what's realistic? It's not 1000x. It's probably also not just 3, 4, 5% per year. Let's try to approximate this. So at least we should get back the monetary debasement, right? This is USM2, and this is going up by roughly 6.8% per annum. This is how much the US dollar debases over time. And who would have thought the S&P 500 goes up by roughly the same amount year over year? Yes, there is a lot of volatility, but have a look at this. S&P 500 divided by the money supply. That's the long-term chart. So this starts in 1959, and since that point in time to today, the S&P 500 outperformed monetary expansion by only 50%, so less than 1 percentage point per year. The vast majority of the stock price appreciation is just monetary debasement. So this is at least what we can expect with crypto returns. Getting the monetary debasement back. The same effect, by the way, holds true for gold. This is the gold price relative to the monetary base. So it's all going up by the same rate that dollars enter the system. But we are in crypto because this is a growth industry, right? More and more capital comes into the space now by an accelerating rate through Wall Street, through the ETFs and through the treasury companies. So let's try to figure out just with Bitcoin, so the least risky of the cryptocurrencies, what we can expect long term. And then of course, as we go into the more risk on stuff, we should at least beat that return. So here's the Bitcoin price long term. And of course, at the beginning, this tended to go up faster than it is today. This is a logarithmic scale, so we can see here the percentage changes. And what we have got in orange over here, that's the realized price. So this shows us the average cost basis of the market. The current price tends to hover around the realized price. So when we are currently below the realized price, it's a good time to buy. When we are above, it's not necessarily as good of a purchasing opportunity. But in general, the realized price tends to just go up over time. It goes up or it goes sideways. And so using the realized price, we can, at least to a degree, get rid of this volatility, right? Those 80, 90% drops in Bitcoin that make it so hard to predict how much Bitcoin long-term grows. Once we take that away and we just focus on the realized price, and let's say we use a conservative estimate, so we start off when the realized price went sideways for a prolonged period of time. Then we can compare the price over here with the price over here. We can see how quickly is this recently going up. And then we have an expected growth rate of the average cost basis of Bitcoin. How much should Bitcoin, if we ignore all the cycles, appreciate over the long term? So I'm dividing $52,000, that's the realized price today, by $20,000, that was the realized price 4 years ago. We get to a growth rate of 2.6, and then we put this to the power of 1/4. So this now annualizes this. It takes the geometric average over 4 years. So we get 27% growth per annum in Bitcoin. This is my best estimate for the Bitcoin price appreciation year over year if the market is not timed at all. If we don't buy the bottoms and sell the tops, if we just buy and hold and keep this running for the long term, 27% per annum is my expected long-term growth target for Bitcoin. 7% of that roughly is monetary debasement. The other 20% of that is just adoption, new investors entering the crypto space. Now, we are not necessarily happy with 27%, so we can of course time the market a bit, right? We can buy when there's money flowing into crypto. So this is the stablecoin market cap. It goes up since October of 2023, and we can avoid crypto when the space is rather shrinking and the stablecoin market cap is going down. This here was the Terra Luna collapse, and during that bear market we also saw FTX blowing up. Or we can time the market even more precisely using the realized price, right? As we already said, instead of using this as a long-term estimate for the growth rate, we can also use this as a market timing mechanism. We buy much more whenever the price is below, but in general we dollar cost average in. We just increase our exposure whenever the market is extremely depressed. But again, we are currently quite far away from that realized price. And it does not necessarily make sense to wait until we dip below, because sometimes we see a massive rally. This is when Bitcoin moved from $300 all the way to $20,000. So if you waited to hit the realized price when Bitcoin was at $500 and you missed out on a 40x return, that would have been not the best idea. So this gives us kind of like our minimum bar, right? If we buy and hold Bitcoin, we should expect at least 27% per annum. If we now trade actively, we should get more return like this. Now here's the difference of this channel to most other channels that you see on YouTube. Those people here, they don't share what they are making long term with their crypto investments. They're just pumping and dumping. But I'm willing to share my returns, and not just in US dollars, but actually relative to what I would have gotten had I just dollar cost averaged into Bitcoin. So this comes directly from my personal Excel sheet. It's monthly data. This is 4 years of data roughly. And had I just dollar cost average into BTC, I would have been over here, but instead I got this return over here. I 3x outperformed just buying and holding Bitcoin. And if we annualize this, right, we take this to the power of 1/4, we get to an alpha of 31% per annum. Which then, if you multiply this with the Bitcoin return, brings us to a fiat return of 67% per annum. And so this is what I believe is realistic long-term in this market. This is a growing market. We get above average returns because of that, but it's also an inefficient market. It's a market where there's a lot of mispricing. If we learn enough about certain mispricing patterns, like let's say certain pump and dumps that tend to deflate very long-term, or let's say about tokenomics, where we see some altcoins underperform other altcoins very consistently. When we look at those pricing inefficiencies, we can have constant outperformance. I don't think it's all just luck. It's luck and skill. And so I don't stop just sharing my own trade performance. I actually started with something. 1.5 months ago, I started a capital pool here for the premium members. The pool has unfortunately already closed. We have hit the deposit limit, but this pool so far is growing pretty much at the rate that I would have expected. It's now at 78% APR. And so far, it only had a maximum drawdown of 2.6%. Now, of course, the volatility is likely going to increase over time, but still, this is the kind of performance that now the community members get just by parking their capital in that pool. And every trade that I execute gets executed in this capital pool as well. It's completely passive return. Now, I had to close the deposits for that capital pool because I first want to try this out. How does it actually work when more people invest? How does the platform work, etc.? So I keep this running until end of the year, but by beginning of next year, I will open another capital pool. Until then, I will of course continue to share my own trades. For example, over here on August 7th, I started entering a Pudgy Penguins short relative to Solana. And since then, Pengu underperformed Solana by 20%, which then led to a nice gain of 32K for the community. Of course, I get my share here as well, but the vast majority of those gains go directly to the members. And so really, instead of just hoping for the next 100x return, I think it's much better just to constantly compound the money. Because especially with those small small meme coins, we can't really invest much, right? We can only invest maybe a few $100 or a few $1,000, hope for the lottery ticket win, hope for the home run. But when it actually comes to real investing for thousands, tens of thousands, hundreds of thousands of dollars, we can't just bet this on a single rug pull. We have to go about this a bit more systematically. And so really, you only have to watch 2 videos to copy trade me. The first one is using perpetual futures on hyperliquid to bet on relative valuations. And the second video is risk management with relative valuation bets. Extremely important, because if you don't know how to manage your risk, this can end up not so nicely. You only get maximum drawdowns of 2.6% if you know how to properly manage your risk. But then once you've watched those videos, you can simply copy trade me. But I want to go one step further. Some of my trades, they tend to outperform so consistently that I'm actually okay with giving the following guarantee. Once you have joined the membership, the premium membership of this channel, you've watched those 2 videos and you've joined the community, then I will send you my favorite trade. If you do not make money with that favorite trade after 1 month of holding that trade, then I'll refund you the membership fee 100%, no questions asked. So you basically get access to this entire tutorial section 100% for free. And you can copy trade everything that I do. A strategy that's constantly making money with the community pool, and it has worked for me for the last 4 years. You get all of that for free if this very first trade that I'm going to send you after joining is not going to work out in the green for you. The membership is currently $125 per month. If you want to be the first people to access the next trading vault at the beginning of next year, then I very much recommend to join even the yearly membership. You can also switch to annual membership at any point in time, but the current copy trading pool has already been closed. Existing members, of course, will get early access before the 2026 pool closes. But again, that might be your next step if you don't want to risk an entire annual payment, which is now $1,250. Feel free to simply just test it out with $125. And again, this is pretty much risk-free since you will get my favorite trade. And if that doesn't work out, I will just refund you. I take that risk. A link to premium pops up on the screen directly over here. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium. Cheers.